Okay, study session 11, still on corporate finance. Now on part 2 of corporate finance. This study session covers how companies make use of leverage and manage their working capital to meet short-term operational needs, the various types of leverage, operating financial total, measures of leverage, and how leverage affects a company's earnings and financial ratios are examined. A discussion then follows on the different types of working capital and the management issues associated with each. The session concludes with techniques for assessing the effectiveness of working capital management, reading assessments or assignments, reading 36 about management measures of leverage, and reading 37 about working capital management. Reading 37, measures of leverage, learning outcomes. The candidate should be able to define and explain leverage, business risk, sales risk, operating risk, and financial risks, classify a risk, calculate and interpret the degrees of operating leverage, the degrees of financial leverage, and the degrees of total leverage. Analyze the effects of financial leverage on a company's net income and return on equity. Calculate the break-even quantity of sales and determine the company's net income at various sales levels, and calculate and interpret the operating break-even quality of sales. Quantity of sales. Introduction to reading presents in elementary topics in leverage. Leverage is a use of fixed costs in a company's cost structure. Fixed costs that are operating costs, such as depreciation or rent, create operating leverage. Fixed costs that are financial costs, such as interest expense, create financial leverage. Analysts refer to the use of fixed costs as leverage because fixed cost acts as fulcrum for the company's earnings. Leverage can magnify earnings both up and down. The profits of highly leveraged companies may soar with small upturns in revenue, but the revenues is also true. But the reverse is also true. Small downturns in revenue may lead to losses, and analysts need to understand a company's use of leverage for 3 main reasons. First, the degree of leverage is an important component of assessing a company's risks and return characteristics. Second, analysts may be able to discern information about a company's business and future prospects for a management decision, but the use of operating and financial leverage. Knowing how to interpret the signals also help the analysts to evaluate the quality of management decision. Third, the valuation of a company required forecasting future flows and assessing the risk associated with those cash flows. Understand a company's use of leverage should help in forecasting cash flows and selecting an appropriate discount rate for funding the present value. The reading is organized as follows. Section 2 introduces leverage and defines important terms. Section 3 illustrates and discusses measures of operating leverages and financial leverages, which combines to define a measure of total leverage that gauges the sensitivity of net income to a given percent change in units sold. The section also covers break-even points in using leverage and corporate reorganization. A possible consequence of using leverage inappropriately. A summary on practice problems concludes this reading. Leverage increases the volatility of a company's earnings and cash flows and increases the risk of lending to or owning a company. Additionally, the valuation of a company and its equity is affected by the degree of leverage. The greater a company's leverage, the greater its risk, and hence the greater the discount rate that should be applied in its valuation. Further, highly leveraged or leveraged companies have a greater chance of incurring significant losses during downturns, thus accelerating conditions that leads to financial distress and bankruptcy. Consider the simple example of 2 companies, Impulse Robotics Incorporated and Mulvey Aerospace Incorporated. The companies had the following performance for the period of study. Okay, let me pour my drink today. I'm drinking diluted apple juice, treetop apple juice today. It's kind of a channel tradition to talk about the drinks I'm drinking today. So 50-50, or more like 60-40. 6 part water, 4 part apple juice. These companies have the same net income, but are they identical in terms of operating and financial characteristics? With the appraisers, would we appraise these 2 companies at the same value? Not necessarily. The risks associated with future earnings and cash flows of a company are affected by the company's cost structure. The cost structure of a company is a mix of variables and fixed costs. Variable costs fluctuates with the level of production and sales. Some example of variable costs are the cost of goods purchased for resale, cost of materials or supplies, shipping charges, delivery charges, wages for hourly employees, sales commissions, and sales for production bonuses. Fixed costs are expenses that are the same regardless of the production and the sale. The company needs to include depreciation, rent, interest on debt, insurance, and wages for salaried employees. Suppose the cost structure of the companies differ in the manner shown in Exhibit 2. The risk associated with these companies is different, although, as we saw in Exhibit 1, they have some of the they have the same net income. They have different operating and financing cost structures, resulting in different volatility of net income. For example, if the number of unit produced and sold is different from 100,000, and the net income of the two companies diverge, 50,000 units are produced and sold. Impulse Robotics has a loss of 200,000, and Marvey Aerospace has zero earnings. If, on the other hand, the number of units produced and sold is at 200,000, Impulse Robotics earns 1 million, whereas Marvey Aerospace earns 600,000. In other words, the variability in net income is greater for Impulse Robotics, which has greater fixed costs in terms of both fixed operating costs and fixed financing costs. Impulse Robotics' cost structure results in more leverage than that of Marvey Aerospace. We can see this effect when we plot the net income of each company against the number of unit produced and sold. As in Exhibit 3, the greater leverage of Impulse Robotics is reflected in the greater slope of the line representing the net income. This means that as the number of units sold changes, Impulse Robotics experiences a greater change in net income than does Marvey Aerospace for the same changes in units sold. Here's the diagram. Companies that have more fixed costs relative to variable costs in the cost structure have the greater variations in net income as revenues fluctuate and hence more risk. Business risk and financial risk arises when both the operating and financing activities of a company in the following. We address how that happens and the measures available to analysts to gauge the risks in each case. Business risks and its components. Business risk is the risk associated with operating earnings. Operating earnings are risky because total revenues are risky. As there are costs of producing revenues. Revenues are affected by a large number of factors, including economic conditions, industry dynamics, including actions of competitors, government regulations, and demographics. Therefore, prices of the company's goods or services or the quality or the quantity of sales may be different from what is expected. We refer to the uncertainty with respect to the price and quantity of goods and services as sales risks. Operating risks is the risk attributed to the operating cost structure, in particular the use of fixed costs in operations. The greater the fixed operating cost relative to variable operating costs, the greater the operating risk. Business risk is therefore a combination of sales risks and operating risk. Companies that operate in the same line of business generally have similar business risks. Sales risks, consider Impulse Robotics once again. Suppose the forecasted number of units produced and sold in the next period is 100,000, but that the standard deviation of the numbers of units sold is 20,000, and suppose the price that the units sells for is expected to be $10 per unit, but the standard deviation is $2. Contrast this situation with that of a company named Tolly Aerospace Incorporated, which has the same cost structure but a standard deviation of units sold of 40,000 and a price deviation of $4. If we assume, for simplicity's sake, that the fixed operating costs are known with certainty, and that the units sold and price per unit follows a normal distribution, we can see the impact of the different risks and operating income of the two companies. Although simulation result of this the results are shown in Exhibit 4. Here we see the different distributions of operating income that results from the distributions of units sold and price per unit. So even if the companies have the same cost structure, different sales risks affects the potential variability of the company's profitability. In our example, Trolley Aerospace has a wider distribution of likely outcomes in terms of operating profit. This greater volatility in operating earnings means that Trolley Aerospace has more sales risks than Impulse Robotics. Operating risks. The greater the fixed component of cost, the more difficult it is for a company to adjust its operating cost to changes in sales. The mixture of fixed and variable costs depend largely on the type of business. Even within the same line of business, companies can vary their fixed and variable costs to some degree. We refer to the risks arising from the mix and fixed and variable costs as operating risk. The greater the fixed operating cost relative to the variable operating costs, the greater the operating risks. Next, we look at how operating risk affects the variability of cash flows. A concept taught in microeconomics is elasticity, which is simply a measure of sensitivity of changes in one item to changes in another. We can apply this concept to examine how sensitive a company's operating income is to changes in demand as measure of unit sales. We will calculate the operating income elasticity, which we refer to as the degree of operating leverage, the DOL. DOL is a qualitative measure of operating risks. As it was defined earlier, the degree of operating leverage is the ratio of a percentage change in the operating income to the percentage change in units sold. We'll simplify things and assume that the company sells all that it produces in the same period. Then DOL equals the percentage change of operating income divided by the percentage change in the units sold. For example, if DOL is a given level of unit sales of 2.0, 5% increase in unit sales from the level that would be expected to result in 10% increase in operating income as illustrated later in the relation to Exhibit 6. A company's DOL is dependent on the level of unit sales being considered. Returning to Impulse Robotics, the price per unit is $10. The variable cost per unit is $2. The total fixed operating cost is $500,000. If Impulse Robotics outputs changes from 100,000 to 110,000 units, an increase of 10% in the number of units sold, operating income changes from 300,000 to 380,000. Operating income increases by 26.67% when units sold increase from 10%. What if the number of unit decreases by 10% from 100,000 to 90,000? Operating income is 220,000, representing a decline in 26.67%. What is happening is that for a 1% change in the units sold, the operating income changes by 2.67 times that percentage. In the same direction, if the units sold increases by 10%, operating income increases by 26.7%. If units sold decreases by 28%, operating income would decrease by 53.3%. We can repeat the degree of operating leverage as given in equation 1 in terms of basic elements of price per unit, variable cost per unit, number of units sold, and fixed operating costs. Operating income is revenue minus total operating costs. Illustrated as such. The per unit contribution margins is the amount of each unit sold contributes to covering fixed costs. That is the difference between the price per unit and the variable cost per unit. The difference multiplied by the quantity sold and the contribution margins, which equals the revenue minus variable costs. How much does operating income change when the number of its units sold changes? Fixed costs do not change, therefore operating income changes by the contributions margins. The percentage change in operating income for a given change in units sold is simplified as such, where Q is the number of units, P is the price per unit, V is the variable operating cost per unit, and F is the fixed operating cost. Therefore P minus V is the per unit contributions margins, and Q minus P minus P multiplied by Q multiplied by P subtracted by V is the contribution margins. Applying the formula of DOL using the data of Impulse Robotics, we can calculate the sensitivity of change in units sold from 100,000 units as such. Yeah, so here's just using the calculation formula. We can see the sensitivity of DOL for different numbers of units produced and sold in Exhibit 6. When operating profits is negative, the DOL is negative. Odd positions just below and just above the points we operate when operating income is $0. Operating income is at its most sensitive on the percentage basis to changes in units produced and sold at the point which operating income is 0. The DOL is defined because the denominator of DOL calculations is 0. After this point, the DOL gradually declines as more units produced are sold. Okay, so that's the graphical illustration. When we now look at a similar situation in which the company has shifted some of its operating costs away from the fixed cost and into variable costs, Marvel Aerospace has the unit sales price of $10, a variable cost of $6 a unit, and $150,000 in fixed costs. A change in units sold from 100,000 to 110,000, a 10% change changes operating profit from 250,000 to 290,000 or 16%. The DOL in the case of 1.6 is as such. We can see the difference in leverage in the case of Impulse Robotics and Marvel Aerospace companies in Exhibit 7 and Panel 8. And in Panel 8, we see that Impulse Robotics has a higher operating income than Marvel Aerospace, when both companies produce this and sell more than 87,500 units, but lower operating income than Marvel, when both companies produce and sells less than such a unit. Okay, so here's the graph illustration, diagram illustration. The example confirms that we saw earlier in our reasoning of fixed and variable costs. The greater the use of fixed relative to variable operating costs, the more sensitive operating income is to changes in units sold, and therefore the more operating risk. Impulse Robotics has more operating risk because it has more operating leverage. However, as Panel B of Exhibit 7 shows, the degrees of operating leverage are similar for the two companies for larger numbers of units produced and sold. Both sales risks and operating risks influence a company's business risk, and both sales risks and operating risks are determined by large part by the types of business and company it is in. But management has more opportunity to manage and control operating risks and sales risks. Suppose a company is deciding which equipment to buy to produce a particular product. The sales risks is the same no matter what equipment is chosen to produce the product, but the available equipment may differ in terms of fixed and variable operating costs of producing the product. Financial analysts need to consider how the operating cost structure of a company affects the company's risk. Industries that tend to have high operating leverage are those that invest up front to produce a product but spread relatively little on making a distributing it. Software developers and pharmaceutical companies fit the description. Alternatively, retailers have a low operating leverage because much of the cost of goods sold is variable. Because most companies produce more than one product, the ratio of variable to fixed cost is difficult to obtain. We can get an idea of operating leverage of a company by looking at changes in operating income in relation to changes in sales for the entire company. This relation can be estimated by regression changes in operating income or on changes in sales over a recent time period. Although this approach does not provide a precise measure of operating risks, it can help provide a general idea of the amount of operating leverage present. For example, compare the relation between operating earnings and revenues from Abbott Laboratories, a pharmaceutical company, and Walmart stores, a discount retailer. Nice, that sells a discount retailer. Lamau. As shown in Exhibit 8, note that the slope of the least square regression line is greater than Abbott, and then for Walmart. We can see the operating earnings are more sensitive to changes in revenues. For a higher operating leverage, Abbott Laboratories are as compared to lower operating leverage Walmart stores. Okay, so we can see the difference in the slope. The financial risks. We can expand on the concept of risks and to accommodate the perspective of owning a security. A security represents a claim on the income and asset of a business. Therefore, the risks of a security goes beyond the variability of operating earnings to include how the cash flows from those earnings are distributed among the claimants, the creditors, and owners of the business. The risks of a security is therefore affected by both business risk and financial risk. Financial risk is the risk associated with how a company finances its operations. If the company finances with debt, it is legally obligated to pay the amount that make up its debt when due, but taking on fixed obligations such as debt on long-term leases, the company increases its financial risks. If a company finances its business with common equity generated either for operations, retained earnings, or from issuing new common shares, it does not incur fixed obligations. The more fixed cost financial obligations, e.g. debt, incurred by the company, the greater its financial risks. When we quantify the risk in the same way we did for operating risk, looking at the sensitivity of cash flows available to owners. When operating income changes, this sensitivity, which we refer to as a degree of financial leverage, or DFL, is as such. For example, DFL at a given level of operating income is 1.1. A 5% increase in operating income would be expected to result in a 5% or 5.5% increase in net income. A company's DFL dependent on the level of operating income being considered. Net income is equal to operating income less interest and taxes of operating income changes. How does net income change? Consider Impulse Robotics. Suppose the interest payment is $100,000, and for simplicity, the tax rate is 0%. If operating income changes from $300,000 to $360,000, net income changes from $200,000 to $260,000. A 20% increase in operating income increases net income by $60,000 or 30%. When what is the fixed financial cost of $150,000? A 20% change in operating income result in a 40% change in net income from $150,000 to a $210,000. So yeah, here's the illustration of such. Using more debt financing, we result in a higher fixed cost, increase in sensitivity of the net income, and changes in operating income. We can represent the sensitivity of net income to a change in operating income, continuing the notation from before and including the fixed financial costs. As you can see, an equation for the factor that adjusts for taxes cancels out of the equation. In other words, the DFL is not affected by the tax rate. In a case in which operating income is $300,000 and fixed financing costs are $100,000, the degrees of financial leverage is as such. Again, we need to qualify our degree of leverage by the level of operating income, because DFL is different at different levels of operating income. The greater the use of financing sources that requires fixed obligations, such as interest, the greater the sensitivity of net income to changes in operating income. Unlike operating leverage, the degrees of financial leverage is most often a choice by the company's management, whereas operating costs are very similar among companies in the same industry. Competitors may decide to differ on differing capital structures. Companies with relatively high ratios of intangible assets to total assets may be able to use higher degrees of financial leverage than companies with relatively low ratios, because the claims on the tangible assets that lenders would have on the events of a default may make the lenders more confident in extending larger amounts of credit. In general, businesses with plants, land, and equipment that can be used to collateralize borrowing, and businesses whose revenue have below average business cycle sensitivity may be able to use more financial leveraging than businesses without such assets. And with relatively high business cycle sensitivity, using financial leverage generally increases the variability of returns on equity, or net income divided by shareholders' equity. In addition, its use by profitable companies may increase the level of returns on equity. Example 3 illustrates both effects. Businesses is generally an uncertain venture. Changes in macroeconomics and competitive environments that influence sales and profitability are typically difficult to discern and forecast. The larger the proportions of debt in the financing mix of a business, the greater its chance that it will face default. Similarly, the greater the proportion of debt in the capital structure, the more earnings are magnified upwards in improving economic times. The bottom line, financial leverage tends to increase the risks of ownership for shareholders. Total leverage, the degrees of operating leverage, gives us an idea of the sensitivity of operating income to a total degree of operating leverage gives us an idea of the sensitivity of operating income to changes in revenues, and a degree of financial leverage gives us an idea of the sensitivity of net income and changes in operating income. But often we are concerned about the combined effects of both operating leverage and financial leverage. Owners are concerned about the combined effects because both factors contribute to the risks associated with their future cash flows, and financial managers, both decisions intend to maximize owners' wealth, need to be concerned with how. Look back at the example of Impulse Robotics. The sensitivity of owners' cash flows is to give, given changes in units sold, is affected by the operation of financial leverage, consider using 100,000 units as the base number of produced and sold. The 10% increase in the units sold represents a 27% increase in operational income and a 40% increase in the net income. Like decrease in units sold result in a similar decrease in operating income and net income. Combining a company's degree of operating leverage with its degree of financial leverage result in degrees of total leverage, a measure of sensitivity of net income to changes in the number of units produced and sold. We again make the simplifying assumption that a company sells all it produces in the same period. This means that we can determine by multiplying the DOL of 2.67 by a DFL of 1.5. That means that a 1% increase in the units sold will result in a 4% increase in net income. A 50% increase in units produced and sold will result in a 200% increase in the net income. A 5% decline in units sold result in a 20% decline in income to owners, and so on, because the DOL is relative to the base numbers of units produced and sold. The DFL is relative to the base level of operating earnings. The DTL is different depending on the number of units produced and sold. We can see the DOL, the DFL, and DTL for Impulse Robotics for different numbers of units produced and sold, beginning at the number of units for which the degree is positive, as seen in Exhibit 14. In the case of operating leverage, the fixed operating cost acts as a fulcrum of the greater and the proportions of the operating cost that is fixed. The most sensitive operation income is the change in sales. In the case of financial leverage, the fixed financial costs, such as interest, acts as the greater the proportions of financing with fixed cost sources, such as debt, the more sensitive the cash flows available to owners are to change the operating income. Combining the effects of both types of leverage, we see the fixed operating and fixed costs together increases the sensitivity of earnings to owners. Break-even points and operating break-even points. Looking back at Exhibit 3, we see that there is a number of units at which the company goes from being unprofitable to being profitable. That is the number of units at which the net income is zero. The number is referred to as the break-even point. The break-even point, or QBE, is the number of units produced and sold at which the company's net income is zero. The point at which the revenues are equal to the cost. Plotting revenues to total costs against the number of units produced and sold in Exhibit 15 indicates that the break-even is at 75,000 units. At the number of units produced and sold, revenues are equal to costs, and hence profit is zero. We could calculate the break-even point for Impulse Robotics and Marvell Aerospace. Consider the net income is zero when the revenues are equal to the expenses. We can represent this equity, the equality of the revenues and costs, by the following equations. So the you look at the equations. This means that Impulse Robotics must produce and sell more units to achieve a profit. So when the higher leveraged Impulse Robotics has a greater break-even point relative to Marvell Aerospace, the profit that Impulse Robotics generates beyond the break-even point is greater than that of the Marvell Aerospace. Therefore, leverage has its rewards in terms of potentially greater profits, but it also increases risk. In addition to the break-even point specified in terms of net income, the QBE, we can also specify the break-even points in terms of operating profit, which we refer to as the operating break-even point. The Q OBE revenues at the operating break-even point are set equal to the operating costs at the operating break-even point to solve for the operating break-even number of units, which is the QOBE. The expression shown in QOBE is equal to the fixed operating cost divided by the differences between the price per unit and the variable cost per unit. For two companies in our example, Impulse Robotics and Marvell Aerospace, the operating break-evens are as such, respectively. Impulse Robotics has a higher operating break-even point in terms of the number of units produced and sold. As businesses expand or contract beyond or below a break-even point, fixed costs do not change. The break-even point for companies with low operating and financial leverage are less important than those of companies with higher leverage. Companies with greater total leverage must generate more revenue to cover fixed operating and financing costs. The farther unit sales are from the break-even point for high leverage companies, the greater the magnifying effect of the leverage. The risks of creditors and owners, as we discussed earlier, business risks refer to the effects of economic conditions as well as the level of operating leverage. Uncertainty about demand, output prices, and costs are among the many factors that affect business risks when conditions changes. For any of these factors, companies with higher business risk experience more volatile earnings. Financial risk is, in addition to the risk that results from the use of debt and preferred stocks, the degree of financial risk grows with greater use of debt. Who bears this risk? The risk providers for equity and debt capital differs because the relative rights and responsibilities associated with those borrowing money in the business. Lenders have a prior claim on assets relative to shareholders, so they have a greater security in returns for lending money to a business. Lenders require a payment of interest and principal when due. These contractual payments to lenders must be made regardless of the profitability of the business. A business must satisfy these claims in a timely fashion or face the pains of bankruptcy should it default. In return to their higher priority and claims, lenders get predefined yet limited returns. In contrast, equity providers claim whatever is left over after expenses, including debt services, have been paid. So, unlike the fixed and known commitments to the lenders, what is left over for the owners may be a great deal or may be nothing. In exchange for the risk, providers of equity capital exercises the decision-making power over the business, including the right to hire, guide, and if necessary, fire managers in public companies. Ownership rights are necessary. Ownership rights are usually exercised through the elected board of directors. They undertake the decision over what portion of the business's earnings should be paid out as dividends for common shareholders. Legal codes in most countries provide for the rights as well as conditions for companies to file for bankruptcies. A number of bankruptcy codes provides the same for two categories of bankruptcy. One for providers of temporary protection for creditors so that a viable business may reorganize. In the United States, the U.S. Bankruptcy Code sets the terms for the negotiation as reorganization of the company's capital structures that allows to remain on the ongoing concern. In Chapter 11 for businesses that are not viable, the second form of bankruptcy processes allows the ordinary satisfaction of the creditor's claims. In the United States, the form of bankruptcy is referred to as the liquidation, whereas both types of bankruptcy lead to major dislocations in the rights and privileges of owners, lenders, employers, and managers. It is in the latter category of bankruptcy that the original business ceases to exist. The difference between a company that reorganizes and emerges from bankruptcy and the one that is liquidated is often the difference between operating and financial leverage. Companies with high operating leverage have less flexibility in making changes, and bankruptcy protection does little to help reduce operating costs. Companies with high financial leverage use bankruptcy laws and protections to change their capital structure, and once the restructuring is complete, can emerge as ongoing concerns. Whereas the ability to file for bankruptcy is important in the economy, the goal of most investors is to avoid ownership of companies that are heading towards this extreme step, as well as to be able to evaluate opportunities among companies already in bankruptcies. Under both Chapter 7 and Chapter 11, providers of equity capital generally lose all value during the bankruptcy. On the other hand, debt holders typically receive at least a portion of their capital, but the payments of principals and interest are delayed during the period of bankruptcy protection. Summary: in this reading, we have reviewed the fundamentals of business risks, financial risks, and managers of leverage. Leverage is the use of fixed costs in a company's cost structure. Business risks is the risk associated with the operating earnings and reflects both sales risk, uncertainty with respect to the price and the quantity of the sales, and operating risks, the risk associated with the use of fixed costs in operation. Fixed financial risk is the risk associated with how a company finances its operations, i.e. the split between equity and debt financing of the business. The degree of operating leverage, DOL, is a ratio of a percentage change in operating income to the percentage change in a unit. So we could use the formula to measure the degrees of operating leverage. As such, the degrees of financial leverage, the DFL, is the percentage change in the net income. For a 1% change in the operating income, we can use the following formula to measure the degree of financial leverage. The degree of total leverage, a DTL, is the measure of the sensitivity of the net income to changes in the units sold, which is equivalent to such. The break-even point, a QBE, is the number of units produced and sold at which the company's net income is zero, which we calculate as such. The operating break-even point is the number of units produced and sold at which the company's operating income is zero, which we calculate as such. Okay, so this is reading 36. We have finished reading 36. I do hope my readings have been helpful. And, we will continue reading 37. Study session 11, part 2, about working capital management in our next session. And I hope to see you guys there. Goodbye.